Three rules, three separate regulatory bodies, all activated within the same 12-month window. And not one mainstream financial outlet has connected them into a single coherent picture. I've spent the last week reading the actual primary source documents. Not summaries, not social media posts. The actual SEBI circular, the actual Texas House bill, the actual IRS code section. What I found is the most consequential regulatory shift for precious metals holders since the U.S. abandoned the gold standard in 1971. I'm Marcus Caldwell, independent market analyst. And before I walk you through all three rules, I need you to do one thing. Drop a number in the comments right now, 1, 2, or 3. Which rule affects your personal situation most directly? Drop your number the moment you hear it. Because one of these three is going to hit very close to home. Before I reveal the first critical regulatory date, if this kind of primary source intelligence is valuable to you, hit subscribe and turn on notifications. This channel reads the actual documents, not the viral posts, not the fear-driven summaries. Your subscription directly supports independent financial analysis. Now let's go through all three, one by one. Rule 1. India rewrites the pricing benchmark for $970 billion of mutual fund capital. Effective in 7 days. On February 26, 2026, India's Securities and Exchange Board, SEBI, issued a circular with a single sentence that almost nobody in the Western financial press noticed. Effective April 1, 2026, every gold and silver ETF in India must value its physical holdings using domestically published MCX spot prices instead of the London LBMA benchmark. That's 7 days from today. Here is why that matters to every silver investor globally. The LBMA benchmark, the London price that has governed Indian ETF valuations since these products launched, has been running $12 to $17 below Shanghai's physical market simultaneously. India's domestic silver premium has historically sat 8 to 12% above the international paper benchmark. When SEBI flips the switch on April 1st, every Indian silver ETF's net asset value will begin reflecting actual domestic market conditions, including that domestic premium, rather than the discounted London paper price. For context on the scale of capital this affects. In January 2026, Indian silver ETFs recorded net inflows of 9,463 crore rupees in a single month. Gold ETF inflows exceeded equity mutual fund inflows for the first time in history during that same month. India's institutional capital is rotating into precious metals at a record pace. And in 7 days, the pricing benchmark that determines what those investments are worth every single day changes from London to Mumbai. India consumes 25% of global annual silver mine supply. It is the world's largest silver importing nation. When India's financial system asserts its own price discovery authority, that is not a procedural adjustment. That is a structural shift in who controls the global silver pricing narrative. Rule 2. Texas makes gold and silver legal tender. Effective September 1st, 2026. Governor Greg Abbott signed House Bill 1056 into law on June 22, 2025. The legal tender provisions activate September 1st, 2026. That is 5 months from today. Texas has a GDP of $2.22 trillion. That is larger than the entire economies of Russia, Australia, and Canada combined. The second largest state economy in the United States will legally recognize gold and silver as money. Not as collectibles, not as investment assets. As a medium of exchange that individuals and businesses can voluntarily use for commercial transactions within the state. The infrastructure backing this law is already built. The Texas Bullion Depository in Leander, Texas allows residents to store allocated gold and silver and transact using those holdings through a card or transfer system that settles in precious metals rather than Federal Reserve notes. Transactional launch is targeted for May 1st, 2027, 14 months from today. Now here is the tax implication that most coverage of this law has completely missed. Under current federal law, every sale of gold or silver triggers a capital gains event. But Texas's legal tender designation creates a specific legal argument already being tested in Utah, which became the first legal tender state in 2011. You don't pay capital gains tax when you exchange dollars for a product or service. If gold and silver are legally recognized as money in Texas, The same argument applies to transactions conducted in those metals. Utah has been testing this argument for 15 years. Texas brings 42 million residents and a $2.2 trillion economy into that legal framework by September. One critical qualifier: the law is voluntary. No business is required to accept gold or silver. No individual is required to hold it. HB 1056 creates the infrastructure and the legal recognition. It does not mandate anything, but the population of Texans who might voluntarily choose to hold and transact in legal tender gold and silver when the depository system launches represents a demand base that no prior precious metals legal tender law in U.S. history has ever had access to. Rule 3. The 28% tax reality every U.S. silver holder needs to understand right now. This rule is not new. It has not changed in 2026. But because silver's gains over the past 14 months have been so large, the existing law now has consequences. At a scale most holders have never faced before. Under Internal Revenue Code, Section 408M, gold, silver, and most other precious metals are classified as collectibles. Short-term gains are taxed at ordinary income rates. Long-term gains are taxed at a flat 28% maximum rate. Not 15%, like most stock gains. Not 20% for high-income equity holders. 28%, flat. Regardless of income level. Here's why that number is critical right now. Silver entered 2025 at approximately $28. Current price after the 44% correction from the all-time high cites at $68. That is a 143% gain for a holder who has been in since January 2025. A position of $100,000 in silver from January 2025 is sitting on approximately $143,000 of taxable profit. At the 28% federal collectibles rate, that is $40,040 of federal tax liability before state income tax and before the potential 3.8% net investment income tax for high-income holders. This is the largest realized precious metals tax event in recent American financial history for holders choosing to sell at current prices. But here is the legal advantage the collectibles classification gives you that equity investors don't have. Silver is not subject to the IRS wash sale rule. The rule that forces stock investors to wait 30 days before repurchasing a security after selling at a loss does not apply to physical precious metals. If you bought silver at $100 and current price is $68, you can sell today, crystallize that tax loss, and immediately repurchase the same position without any waiting period. The loss offsets gains from other collectible sales, or up to $3,000 of ordinary income. Your silver exposure is restored without interruption. For holders with realized gains above $100,000, Wealth Management's February 4th analysis identified a second strategy. The Federal Opportunity Zone deferral under IRC section allows you to roll gains into a qualified Opportunity Zone fund within 180 days of sale and defer tax recognition for up to 5 years. Given that silver's structural thesis points to significantly higher prices in that time frame, deferral and continued exposure may produce a better after-tax outcome than selling and repurchasing at today's prices. Here is the honest counter-argument, and this channel always gives you both sides. The regulatory headlines around precious metals in 2026 have generated significant fear-driven content that does not hold up to primary source scrutiny. The IRS has not issued a new silver crackdown rule. The Form 8300 cash reporting threshold remains at $10,000 unchanged. Posts claiming the government is confiscating gold are not supported by any legislation or executive action. SEBI circular changes India's ETF valuation methodology. It does not touch Indian silver holdings. Texas's law creates a voluntary framework. It does not mandate that anyone use gold as money. The 28% collectibles rate is existing law. It has not been raised or specifically targeted at precious metals in 2026. The investors who panic sell based on misread regulatory headlines are the ones who pay the highest tax bills and exit their positions at the wrong moment. Clarity is a competitive advantage. That is not a motivational statement. It is the specific edge that separates informed holders from reactive ones. Here is what to watch and when. Watch April 1st for any data on Indian ETF NAV changes after the SEBI MCX pricing switch activates. If Indian silver ETF valuations begin rising relative to LBMA-linked international products, the pricing divergence thesis is being confirmed in real time. Watch September 1st, 2026 for the Texas legal tender activation. Specifically watch for any IRS guidance on the capital gains treatment of gold and silver transactions in legal tender states. Utah has been waiting 15 years for that guidance. Texas may finally force an answer. If you are a U.S. holder sitting on significant silver gains from 2025, the 180-day Opportunity Zone deferral window starts from your sale date. Consult a tax professional before that window closes. 3 rules. April 1st, $970 billion of Indian mutual fund capital switches its silver pricing benchmark from London to Mumbai. September 1st, 42 million Texans gain access to a legal tender framework for gold and silver transactions. And the 28% collectibles rate is the existing federal law governing the most profitable silver position most American holders have ever held. Understanding all three is the difference between operating from a position of strength and operating from a position of fear. The rules are documented, the implications are real, and the investors who read the primary sources before acting are the ones who come out ahead. If this analysis gave you an edge today, like this video, share it with one silver holder who needs to see it, and I'll see you in the next one.